So you want to own a solar farm. Rows of panels stretching across empty land, soaking up sunlight for free, converting it into electricity you sell for decades with almost no moving parts to break down. No fuel to buy, no smokestack, no miners underground, no drilling rig, just silicon, sunlight, and a contract that pays you every month for 25 years. That's the pitch. And on paper, it's one of the closest things to a truly passive infrastructure business that exists. Here's what the pitch leaves out. The reason solar farms look like a printing press for money is the same reason so many of them sit half-built for years waiting on a single piece of paperwork, and the reason the biggest energy companies on the planet have learned to treat this business as anything but simple. Let's start with what you're actually buying, because a solar farm isn't really a technology business. It's a real estate business with an electricity contract bolted onto it. And the land decision alone will make or break the entire project before a single panel ships. A utility-scale solar farm needs somewhere between 5 and 10 acres per megawatt of capacity, depending on the panel technology and the terrain. A modest 100-megawatt farm, enough to power roughly 20,000 homes, needs somewhere between 500 and 1,000 acres of land. That land doesn't need to be prime real estate. In fact, the best solar land is often flat, unshaded, agriculturally marginal farmland or scrubland, the kind nobody wants for much else. This is one of the few businesses where cheap, undesirable land is actually the correct answer, not a compromise. Land suitable for utility solar typically leases for somewhere between $500 and $2,000 per acre per year, and most developers lease rather than buy outright, locking in 25 to 35-year land leases that match the project's operating life. On a 1,000-acre project, that's somewhere between $500,000 and $2 million a year just in land lease payments before a single watt of electricity is generated. Here's the detail that catches almost every new developer off guard. Before you can even sign that lease with confidence, you need an interconnection agreement, permission from the local utility or regional grid operator to actually plug your farm into the transmission system. And this is where solar development turns from a construction project into something closer to standing in a very long, very expensive line. Every proposed power plant in a region, solar, wind, gas, battery storage, has to submit an interconnection request and get studied by the grid operator to determine whether the existing wires and substations can handle the new power without breaking something. According to data from the Lawrence Berkeley National Laboratory, the typical wait time in interconnection queues across the United States has stretched to somewhere between 3 and 5 years, and in some regions considerably longer, with total capacity waiting in queues now exceeding 1,000 gigawatts nationwide, more than the entire existing generating capacity of the country. Projects that entered a queue expecting an 18-month review have in real cases waited 7 or 8 years watching their equipment cost estimates, their land lease terms, and their financing assumptions go stale while regulators work through a backlog that keeps growing faster than it clears. And the interconnection study itself can force devastating cost surprises. If the grid operator determines your farm would overload a nearby substation or transmission line, the study can assign your project a share of the upgrade cost required to fix it, sometimes tens of millions of dollars for infrastructure that benefits the entire regional grid, not just your farm. A project that penciled out perfectly at the land lease stage can become uneconomical the day the interconnection study comes back, and by then, you've often already spent years and millions of dollars in development costs just to find out. So say you've cleared the interconnection hurdle, secured your land, and you're ready to build. Now come the panels themselves, and this is where the technology story gets genuinely interesting, because the actual hardware has become remarkably cheap while everything around it has not. Solar panel prices have fallen dramatically over the past decade, and utility-scale solar panels today typically cost somewhere between 20 and 30 cents per watt of capacity. On a 100-megawatt farm, that's roughly $20 to $30 million in panels alone. But panels are only one piece of what the industry calls the balance of system, everything else required to actually turn sunlight into usable electricity. You need inverters, the equipment that converts the direct current the panels produce into the alternating current the grid actually uses, racking and mounting structures to hold thousands of panels at the correct angle, often on single-axis trackers that slowly rotate to follow the sun across the sky and can boost output by 15 to 25%. You need miles of underground and overhead cabling, a substation to step the voltage up to transmission level, and a security and monitoring system to watch over hundreds of acres of unattended equipment. All told, a fully installed utility-scale solar farm typically costs somewhere between $800,000 and $1.3 million per megawatt, meaning a 100-megawatt farm can run anywhere from $80 to $130 million once land, interconnection, equipment, and construction are all accounted for. Here's a cost most people never think to ask about until the engineering report lands on their desk. Trackers, the motorized systems that tilt panels to follow the sun, are mechanical devices in a field getting rained on, snowed on, and baked by UV exposure for decades. They fail, motors burn out, gearboxes wear down, and a stuck tracker doesn't just stop tracking, it can leave panels angled incorrectly for months if nobody catches it, quietly reducing the farm's output without triggering an obvious alarm. This is why serious operators run continuous performance monitoring software that compares each individual string of panels against its expected output. Because on a farm with hundreds of thousands of panels, a handful of underperforming sections can hide in the averages for a long time if nobody is specifically looking for them. Now let's talk about where the money actually comes from, because this is where solar economics diverge sharply from almost every other business we've covered in this format. A solar farm doesn't really sell electricity on the open spot market the way you might picture a power plant operating. Almost every utility-scale solar farm signs what's called a power purchase agreement, a long-term contract, typically 15 to 25 years, locking in a fixed price for every megawatt hour the farm produces, sold either to a utility company or, increasingly, directly to a large corporate buyer like a technology company or manufacturer that wants to claim clean energy for its own operations. This is the single most important financial fact about owning a solar farm. You're not really in the business of selling electricity at whatever the market happens to be paying that day. You're in the business of locking in a predictable, bond-like cash flow for 2 decades in exchange for accepting a price today that might look conservative later if wholesale power prices rise, or brilliant later if they fall. Recent power purchase agreement prices for utility-scale solar have typically landed somewhere between $25 and $45 per megawatt hour, depending on the region and the buyer, though prices have climbed somewhat in the past 2 years as interconnection delays, equipment costs, and financing costs have all risen simultaneously. On top of the power purchase agreement itself, there's a second and often larger revenue layer that barely existed a decade ago and now frequently makes or breaks a project's returns entirely: federal tax incentives. Under current federal policy, utility-scale solar projects can claim an investment tax credit worth 30% of the project's total cost, and in many cases meaningfully more if the project meets domestic content requirements, is built in an area with a retiring fossil fuel plant, or qualifies for other bonus provisions. On a $100 million project, a 30% credit is worth $30 million, money that flows directly against the developer's tax liability, and increasingly thanks to policy changes that allow tax credit transferability, can be sold to other companies for cash, even if the developer itself doesn't have enough tax liability to use the credit directly. This transferability market has become its own quiet financial ecosystem, with credits trading at a discount to face value, typically 90 to 95 cents on the dollar, giving developers a way to monetize the incentive almost immediately rather than waiting years to use it against future taxes. Here's the part of the story that should make you pay close attention if you're thinking about this as a long-term investment. Federal solar tax policy has changed meaningfully multiple times over the past 2 decades, and provisions that exist today are not guaranteed to exist in the same form for the full lifespan of a project being developed right now. A farm modeled around a 30% tax credit that gets reduced or restructured partway through development can see its entire return profile shift dramatically. And unlike a change in wholesale power prices, which markets can hedge against, a change in federal tax policy is closer to a fixed cost of the business suddenly becoming a variable one, entirely outside the developer's control. Layer on top of that a third revenue stream that's become increasingly significant: renewable energy credits, tradable certificates representing the environmental attribute of each megawatt hour of clean electricity generated, which can be sold separately from the electricity itself to utilities or companies needing to meet renewable portfolio standards or voluntary sustainability commitments. In strong markets, these credits can add another meaningful slice of revenue per megawatt hour on top of the power purchase agreement price, though credit prices vary enormously by state and have proven considerably more volatile than the underlying power purchase agreement. So the machine sounds like it prints money from three directions at once. Now here's the other side of the ledger, because a solar farm's operating costs are lower than almost any other power plant, which is precisely what makes the fixed costs that do exist disproportionately important. Operations and maintenance for a utility-scale solar farm typically run somewhere between $10 and $20 per kilowatt of capacity per year, translating to roughly $1 to $2 million annually for our 100-megawatt example. That covers routine cleaning, since dust and pollen buildup on panels can reduce output by several percentage points if left unaddressed; vegetation management to keep grass and shrubs from shading the panels; inverter servicing, since inverters typically need replacement or major refurbishment once during a 25-year project life; and the tracker maintenance we already discussed. Insurance for a project this size, covering equipment damage, business interruption, and liability, typically runs several $100,000 annually and has been climbing as insurers price in increasing frequency of severe weather events, hailstorms in particular, which can shatter thousands of panels in a single afternoon. Here's the trap that catches new solar investors almost every time, and it's a trap built entirely around a single word: degradation. Solar panels don't produce the same amount of electricity forever. Every panel loses a small percentage of its output capacity every single year, typically around 0.5% annually for modern equipment, meaning a farm that produces its rated capacity in year 1 is producing meaningfully less by year 20, even with zero mechanical problems and perfect maintenance. This isn't a malfunction. It's baked into the physics of the silicon itself, and every serious financial model for a solar farm has to account for this steadily declining output curve rather than assuming flat production for the life of the project. A farm modeled optimistically on flat output projections can come up significantly short of expected revenue by the back half of its operating life, precisely the years when the initial financing has typically been paid down and investors are expecting the strongest free cash flow. Weather adds a second layer of variability that, unlike degradation, cuts both ways year to year rather than steadily downward. A solar farm's output depends directly on how much sunlight actually reaches the panels, and cloud cover, wildfire smoke, and unusually overcast seasons can meaningfully reduce a farm's output in any given year compared to the long-term average the project was financed against. Extended droughts in some regions have paradoxically hurt solar output by increasing airborne dust and reducing air quality enough to measurably cut throughput, an effect few early solar models fully accounted for. A farm that underperforms its weather assumptions for 2 or 3 consecutive years can find itself meaningfully behind on the debt service coverage ratios its lenders expect to see, even though nothing mechanical went wrong at all. Now let's run the actual math the way a developer has to run it. Take our 100-megawatt farm built for roughly $100 million all in, including land, interconnection, equipment, and construction. In a strong year, the farm produces close to its rated capacity, sells its output under a power purchase agreement averaging $35 per megawatt hour, and layers in a modest additional revenue stream from renewable energy credits. On a farm generating roughly 220,000 megawatt hours annually, that's approximately $8 million in power purchase agreement revenue, plus a meaningful renewable energy credit contribution, landing total annual revenue somewhere around $9 to $10 million. Subtract operations and maintenance at roughly $1.5 million. Subtract insurance and land lease payments at roughly $1 million combined. Subtract debt service on the underlying financing, and a well-structured project can generate somewhere between $4 and $6 million in annual free cash flow in a strong year. A genuinely attractive return once you factor in the $30 million tax credit that offset the upfront capital cost. Now, the realistic bad year. Panel degradation has quietly reduced output by several percentage points compared to year one. A stretch of unusually cloudy weather cuts production further below the long-term average the project was financed against. A tracker motor failure goes undetected for 2 months in a remote section of the farm, quietly reducing output from that section without triggering an obvious system-wide alarm. Meanwhile, insurance costs have climbed following a regional hailstorm that damaged a neighboring solar project, even though your own farm was untouched because insurers price risk regionally, not just per project. Revenue for the year comes in meaningfully below the original financial model, while your debt service, which was calculated assuming closer to the rated capacity, doesn't move at all. The difference between the good year and the bad year on this exact farm, same panels, same land, same power purchase agreement, can be the difference between comfortably covering debt service with room to spare and drawing down a reserve account that was never meant to be touched this early in the project's life. This is the part of the story that explains why the biggest energy companies and infrastructure funds in the world have become the dominant owners of utility-scale solar, rather than individual investors building one farm at a time. Because the way institutional capital makes this work isn't really about optimizing a single project's weather luck. It's about portfolio diversification across dozens or hundreds of farms spread across different climates and grid regions. A single independent solar farm typically gets valued and financed based on its own project-specific risk profile. But a portfolio of 50 or 100 farms, standardizing procurement, spreading weather risk, and negotiating better financing terms across the whole platform can access capital at a meaningfully lower cost and absorb the bad year variance that would meaningfully strain a single project owner. This is precisely why so much of the utility-scale solar being built today sits inside the portfolios of a small number of large developers and infrastructure funds, rather than being spread across thousands of independent owners the way rooftop residential solar is. So does owning a solar farm actually work as a business? The honest answer is that it depends enormously on something almost nobody outside the industry fully appreciates before they get involved. How much of the return is actually coming from selling electricity versus how much is coming from a stack of federal and state incentives that can shift with the political and regulatory winds far more easily than the sun stops shining. A solar farm isn't really a technology business or even purely an energy business, even though the panels in the field make it look like both. It's a long-duration financial instrument built on a physical asset that degrades slowly and predictably, wrapped inside a policy environment that can change far less predictably. And the gap between those two timelines, the physics of silicon and the politics of tax credits, is where the real risk in this business actually lives.